Wealth Nation, let's face it, many families do not actively plan for their legacy, meaning what's going to happen when you pass away. So in this video, we want to flip the script and we want you to leave your family prepared. Let's no longer be okay with leaving our family high and dry because we don't want to have the conversation.
Right, we're going to discuss a very well-known strategy called the Rockefeller waterfall method. It's a strategy in which the Rockefellers were able to grow, build, and transfer wealth since the 1900s. That's a very long time.
Yes, exactly. So let's just jump into it, okay? So the waterfall method is very simple, but like we said, we'll break it down even further so that we can make sure that you understand what it is. Basically what it is, the Rockefellers have life insurance on every member of their family. The beneficiary of those life insurance policies is a trust, meaning if the insured passes away, those death benefit proceeds are going to go to the bank account of the trust, and the trust already has a written set of rules as far as what needs to happen with the money. So the money is then going to be deployed to make more money, invest in businesses, figure out ways to create more cash flow. Those returns are going to come back to the trust and we're going to keep it going. That's the essence of what this is. And the point is, any money that is accumulated, we're going to go back, reevaluate the family. Who else needs policies? Get some more policies and keep the good times going.
What other ways are there to make money?
Exactly. So we have a plan in place. It's owned by a third party, not individuals, because we know that can get spicy. And the idea is everyone understands the trust, the rules in the trust, and what's happening.
Now, breaking this down a little more, let's introduce some vocabulary words. We have the owner. The owner of a life insurance policy can be Carmen, or it can be me. It can be an individual, or it can be an entity like a trust. That is the owner. It's the person who pays the life insurance policy. The insured is the individual the policy is on. That means if something was to happen to this individual, then the beneficiary will receive a sum of money that's predetermined by the insurance company.
Yeah.
Now, the beneficiary, since I introduced that, is the person who gets to benefit from the death of the insured. It can be the family, like Carmen, or it can be a trust. So that death benefit, another example, is a predetermined amount of money that is determined by the insurance company from the owner paying the premiums.
So as we put it all together, thinking about the Rockefeller method, the owner can be the trust. The insured is going to be a person, whomever the family member is at the time, and then the beneficiary is going to be the trust.
Right.
All right, so those are things to consider. So the other thing that we want to put into this practice is also considering not only are adults being insured, but children are also insured. So every single member, you can get policies as early as 15 days old. Every member of the family has life insurance because every single member of the family is providing a value.
Right. This is important in this scenarios because the cheapest policy you'll ever get is on a 15-day-old.
Yes.
They haven't had any
They have no history.
They don't have any history, literally. So you can buy a life insurance policy on a 15-day-old that's basically pennies on the dollar when you compare it to somebody that's 50 years old.
And it has longer to grow and mature, obviously. The other thing to consider with this Rockefeller method is if the owner of the policy is the trust is also going to be in charge of what happens with the cash value. Because now the family has access to more funds that they can use while we're living, right? Because we're talking about living, right? We're not just talking about death. I think sometimes people confuse trust with only being death activities, but no, trust is a living opportunity for us to dictate what's going to happen on our day-to-day. So anytime the cash value is available, the trust can say, hey, what are we going to do with this cash value? Are we going to deploy it for more business opportunities, more cash flowing opportunities? What are we going to do? If a family member passes away, the trust is going to say, okay, now we have these funds. Now we're going to go invest it in X, Y, and Z.
Let's not underestimate the value of cash value, because some very large Fortune 500 companies have gotten started because of the cash value. Like, for example, Walmart, Home Depot, McDonald's, Disney. There's a number of companies that have gotten started because of the value of cash value. Now, let's talk about bank-owned life insurance. Banks are the largest purchasers of whole life insurance. Is it because of the death benefit? They're waiting for a death benefit? No, it's because they can access that cash value without creating a taxable event, because it is a loan. So when it comes to the Rockefeller waterfall method, there is something to be understood in this strategy as to the fact that a family can control a system but not own it.
That's a good point. Yeah. So now let's bring some real life scenarios into this. Okay. So for example, let's take Darius and myself. So we both have policies, and the beneficiary of our policies is our trust. The reason being is because we want a third party to own and operate this trust. And we, Darius and I, have discussed what the rules are within the trust. So should a death benefit pay out, some of the things that we've discussed is, where does the money go? Can it go to business opportunities? Can it go towards travel? Can it go towards education? Can it go towards getting married, right? Because we have children. What can the children do with these funds? We aren't paying for love. Okay,
right.
So just we're
just giving you an example.
You can go get married at the courthouse for $75. We'll pay for the business expense and your educations, everything else, right? So those are the things that we typically discuss. There's rules and outlines as far as how this happens. So anytime money goes into the trust, we can have this discussion. Now, real life happened, family. We have 2 daughters. One, our youngest daughter, passed away. She was born with a terminal illness, and we were able to have a life insurance policy on her. So when the death benefit proceed passed away, it went to the trust, and inside the trust, Darius and I had discussed what happens when money is deployed in there. So what did we do? We were able to use a portion of those funds to reinvest back into business opportunities to keep cash flow going.
Right. So this is, in this example, you don't have to wait for somebody to pass away in order to start using the system.
True.
Ideally, you want to practice using the system while you're alive so that you can make sure that you have the right people in place and have the right system so that your family can continue to use this in your absence. Because when using the system, it becomes, what do you call it? It becomes
habitual?
A hobby. It becomes habitual. Yeah. And right now, we're habitual with a system that we may not benefit from as much, but we can create a system that we can benefit from.
Now let's talk about what Darius is talking about when he says a system. Usually when you own a trust, there's some parties involved, third parties involved. So one being the trustee, the person who is making the decisions on the trust's behalf, right? And then you're gonna have what we call a board of directors. So you are going to nominate people to help manage this whole situation. It could be family, it could be friends, it could be, professionals. But the idea is you're gonna bring people together and everybody has to meet and be on the same accord as far as what's happening with this trust. That's what we're talking about when we meet systems, because it's a little bit more deep than just signing up for a trust.
Right.
Right. Because here's the other thing that we want to make sure that we clear up, because this is Wealth Nation and we want to give you the truth, is just because you got a trust and you name the beneficiary trust doesn't mean that you're doing the Rockefeller method. Right? We talked about you need trustees, you need board of directors, you got to meet annually, you got to keep your notes, you got to keep everything organized. You got to have conversations, right? So if you just sign up for a trust and you make that investment and you're not willing to make the time investment to keep the trust going, maybe you just name a person as a beneficiary. Being honest.
Right, because it's a business.
Yeah.
And in order for a business to run, you have to have the right people in the right positions in order for that business to be successful. And in this particular business, we're talking about your family being successful for generation after generation.
Yeah, so you have to take it seriously. And there's also an investment with a trust, right? Trusts aren't free. Trust can be several thousands of dollars and they can cost as much as a Tesla, right? So it depends on how in depth your assets are. And the conversation I think we need to put out there is, does it make sense for you to have a trust, right? Many people who don't own anything don't necessarily need a trust, because a trust is really where you're going to have a centralized place to hold all of your assets. So if you don't own much, maybe you just start with the beneficiary being a person. But if you have houses and investments and all sorts of things, you need a centralized place for one entity to own it. It might make more sense for that.
Right. The point of this video is for you to start getting in the mind frame of creating a system, and then later you can add the necessary tools onto it. As your understanding becomes more clear and your strategy becomes more clear, so that you're not just buying things just for it to sit on the shelf. Everything that we buy, we want it to be used. That's why when we talk about whole life insurance on this channel, we're talking about using the cash value to make investments. The reason why is because it goes to a bigger system, which is generational wealth. And that doesn't happen by just buying something and just letting it sit.
Yeah.
What do you buy that you let sit? You don't buy a house and never live in it. You either live in it or you get tenants. You never buy a car and let it sit in the garage. No, you drive that car around, because if you don't use it, it would break apart. If you don't move around, you'll fall apart. So the same thing should apply when it comes to every single tool that we buy, especially when it comes to the system or the idea of creating generational wealth for our family.
So the simplified version, right, of the Rockefeller method, as we're talking about, every member of the family has life insurance. The trust is going to be the beneficiary. So that way, when anyone passes away, the proceeds, the death benefit proceeds, go towards the trust, and the trust already has the law. They know what's going to happen, and then the money is redeployed to make more money and bring more money back to the family, right? And then the trust can also be the owner of the policy and dictate what happens with the cash value in the policy. Are we using that for more business endeavors? What is the point? So the point is we're going to reevaluate the family on a yearly basis, and we're going to look at who else needs more death benefit, who else can qualify for more life insurance policies, because we know that life insurance is one of the amazing ways to literally have your net worth, and it doesn't cost your net worth in order to own this asset.
Right. So the moral of the story is just because you pass away doesn't mean that your money stops moving. If the Rockefellers gives us an example of anything, is the fact that this started back in the early 1900s. It's past that. It's 100 years later. So what systems do you have in place now that you can say, okay, 100 years from now, or 10 years from now, that it'll still be in place?
Next year.
What
you got? What you got that say next year I can hold this up? So remember too, every member of the family brings value in many different ways. And so we need to secure that value by having as much life insurance as we possibly can on all of our loved ones. So if you are ready to add more value to your family, then click on the link below and join the Wealth Nation.
Right, and if you want more information similar to this one, check out our next video on the roles of wealth.
And remember to own your own lifestyle.
Or someone else will.